So let's talk a little bit about Treasury yields.
Hmm.
Super exciting in some ways, boring in others. I used to be really bored by bonds, but the bond market has become something of real interest for me, especially as things have gotten so crazy and I've started to recognize how valuable looking at something like the Treasury yield curve is for determining whether or not we'll have a recession.
Mm.
Super interesting stuff. Treasury yields, that's effectively just the annual interest uh, rate that the U.S. government pays on one of its debt obligations being treasuries, treasury notes, treasury bills, whatever, what have you. And these are expressed as a percentage. So imagine you own the 10-year, which is the most liquid treasury bond out there. And it's the one that most people talk about when they're talking about treasuries. If you own a 10-year treasury, for example, at a yield of 4.5%, you can expect a $45 annual return on a $1,000 investment at the end of your maturity. So if you have a 10-year bond, you would expect to receive $45 per year on that particular bond. That all would be paid to you at the same time at the end of 10 years. This is important because this market is partially speculative, because you can, if you want to, for example, sell that 10-year bond 5 years in, but the market would determine that price. Whereas
Mm.
if you hold this thing to maturity, you'll receive the total value of your bond, $45 at a 4.5% curve, at a 4.5% yield. You'll receive that over 10 years, 450 bucks in this case, at the end of this bond treasury maturity. When you're thinking about the origins of this thing, treasury yields have been around for as long as treasury notes, treasury bills, treasury bonds have been around. The first was introduced back in December of 1929. It was a 13-week bill, if you believe it. Super, super interesting, super odd timing, but that's just what it was. Treasury notes and bills are government bonds which pay interest to the bondholder upon maturity. We've already talked about that a little bit. When we're talking about calculations here, the reason why I want to talk about the yields and the yield curves and situations like that is because this morning, when we got this inflation news, we saw equities shoot up, which makes sense. I think most people have an understanding of equities and how when we have positive inflation news, equities have a tendency to go up, but the bond yields have a tendency to go down on the same kind of news. Yield goes down when treasuries are more in demand. The yield curve is a tool that's used to show optimism in the bond market. Yields falling often indicates that there's optimism around issues like interest rates set by the Federal Reserve. So, talking a little bit about this morning, when everything skyrocketed, treasury years fell due to the positive inflation news.
Hmm.
Basically, what's happening here is investors believe that rates will not rise any further, regardless of how many meetings the Federal Reserve has, regardless of how many times His Royal Highness Jerome Powell gets away from the throne and begins to address us plebeians on what he plans to do with money for the rest of the world. We don't think that he'll actually cut. I'm sorry, we don't think that he'll actually raise anything. We think he'll say a bunch of really beautiful, well-written words that speech writers sweat over for months on end when they're putting together his speech, and he won't do anything with it. He'll just say, yeah, we're not going to do anything, and then in May they'll cut. That's the idea. When we talk about this stuff, when we talk about yields and treasuries, a lot of traders, a lot of you guys, I imagine, aren't actually trading this stuff. A
Hmm.
lot of people are actually using this stuff as an indicator for where the economy is going. This is a chart that I've stolen off of the Fed website. The Federal Reserve, I believe, of St. Louis produces this stuff. Absolutely incredible tool. It allows you to chart a variety of very interesting economic situations and economic data. This one takes a look at the 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. That's a lot of mumbo jumbo. All it means is we're taking the yield from the 10-year and we are subtracting the 2-year from it in order to get this curve. Why does this thing matter? It's because when you hear about inverse yield curve, this is what people are talking about. The reason why that's important is because there's a tendency, this doesn't always happen, there's a tendency where when the yield curve goes negative, we see a recession follow. As you guys can see here, looking at this little blue dot I have, this guy back in 1980, we went negative. We started going negative in the 70s. In 1980, we saw a small recession. Same thing happened in the middle of the 80s, right around 1983, I believe it was. We went negative again, and then we saw a recession. Same thing happened into the early 1990s. The dot-com bubble, we went inverse for just a second. We saw a recession. 2008, we went negative for what felt like moments, blinks of an eye. We went negative, and then we saw a recession. And now we are seeing something very similar happening. It doesn't always happen, like I said. But it's an indication that things could happen. Now, the beauty of this is as yields continually fall, chances are, hopefully, we'll start to see this yield curve become more positive as the yields for the 10-year balance out and become much more valuable than the yields, say, for something like the 2-year, which is a smaller mature. But either way, it's something important and a valuable thing to take a look at. Little tips and tricks I like to throw in here. If you have any treasuries, hold on to them. Hold on to them because as the yield falls, the opportunity for you to make money also falls, right? So the Don Dawsons of the world are probably very hurt to hear the news that we heard this morning because their treasury investments won't be as valuable. If you ever considering getting into treasuries, this could be a good time. If things continue to go in this direction, if CPI continually produces flat estimates, which I don't see how that would happen, but it printed flat this morning, so who's to say it can't again? If CPI continually prints in this direction, then we can take that in consideration and say that yields will continually fall. So that would make now a decent time to invest in some treasuries if you ever wanted to diversify. Lastly, if you're day trading the 10-year or any type of yield like this could be a really great opportunity for you to start thinking about some shorts and piling into a short position. That is all she wrote. Thank you for joining us here at the Trading Lab.